Hi, I'm Nick Stenger. We're Stenger Family Office. For the past 43 years, the Stenger family has been advising ExxonMobil families and retirees, helping you make sure that your plan is on track and in good shape, whether you're nearing retirement or a little ways from retirement, whatever is going on your end, we're here to help you out. And we are based in Naperville, Illinois, where we got started in the Joliet refinery advising ExxonMobil families, actually Mobil way back in the day, 1981. And now we have an office across the street from campus in Spring. If you know where Common Bond is, if you're at headquarters there, our office is in the fourth floor. So stop by sometime, see us, and come over for an appointment. But today I want to talk to you about what to do with your Voya 401k amidst the election looming here in November, just a few weeks away now. A lot of people are saying, Nick, how should I be invested, whether it's my personal account outside of Voya or Voya itself, where a lot of our assets are likely tied up at this point? How should I be invested before November? And the reality is you should not be thinking as much about November as you should be thinking about your individual goals-based plan. And so you don't want to get onto a risk-based plan where all you're doing is filling out a risk tolerance questionnaire, which a lot of well-meaning, well-intentioned advisors will have you do. They'll say, fill out this chart, we'll give you a score and tell you exactly where you stand. And you're going to end up in the moderate portfolio, for example. You're going to be a 6 out of 10 risk score. And because of that, you might be moderate plus. Well, that's an okay thing to do eventually, but you don't want to start at that point. If you start from a risk-based plan, you're always going to be thinking about the potential risks of the market. And the reality of being an investor and being in equities in particular is you're always going to have to deal with risk. You're always going to have to deal with volatility. What you rather want to do is start from a goals-based approach, and that's what we do at Stenger Family Office. So if you're our client and you're asking for rebalancing advice right here before November, we're going to say, well, what's your goal? What plan are you on? What's your end goal? Well, your end goal is when you retire to make your money last well into your retirement years, even if you live till 90 or 92 or 95, however long it is you're going to be around. We want to make sure that you're not going to run out of money in retirement. So that's your end goal. That's the most important thing to look at. And then between now and retirement, our goal is to make sure that you can have a rainy day fund if there's bad things that are going on, or there's some change with your job, or something happens that's unexpected, maybe a major storm, or maybe something happens. You need some emergency reserves. We want to make sure that not all of that money is tied up in the market. So that's just sensible, common sense financial planning. And so you got to make sure you've got the right amount in emergency reserves. Then it's the midterm things you might want to do. Maybe you're going to pay for your kid's school. Maybe you're going to have a child get married that you want to contribute some money towards. Maybe there's a new home purchase that you're looking at. There's a million things that you can put into that midterm bucket. So once we solve the end goal, which is making sure you don't run out of money at retirement, and then we have enough money in cash reserves on the front end, then we figure out the midterm goals. Once all of those goals are now planned for and things are accounted for within your financial plan, you're set. You don't have to worry about November. You don't have to worry about geopolitics. You don't have to worry about the price of oil. You don't have to worry about the Federal Reserve and interest rates. You're worried about your long-term plan. And your long-term plan's biggest risk is not stock market volatility. It's the chance of running out of money in retirement because of inflation. That's your big risk. So you need to reframe how you think about your long-term plan so that you aren't starting from a risk-based approach. You're rather starting from a goals-based planning approach. Now, what are some of the likely outcomes that we could have in November? Well, one of the first is you could have divided government. You could have Democrats in the White House. You could have Republicans in the Senate or the House, and not a whole lot of anything gets done. That's very typical in American politics, especially after the first election season, this next 4-year cycle. We're eventually going to get into a midterm cycle in 2 years. And then the likelihood that there's divided government even goes up higher. And so a lot of presidents, including President Trump, including President Obama, yes, they were able to pass some of their agenda, but it always gets backstopped to a large extent in Congress. Bill Clinton had the same issues. George Bush had the same issues. This is not radically new stuff. That's the beauty of our country. We do have checks and balances. We have divided government. So if you're hoping for a good outcome in November, at least a neutral outcome, what you should be hoping for is at least divided government. So that's what we're watching. Now, in the other scenarios, you could have Republicans win all three branches. You could have Republicans in the president, the Senate, the House. And I think in that scenario, you get lower taxes, you get higher deficits temporarily, you maybe continue the trade war with China. So you need to watch your international exposure. That's some of the potential outcomes you could see. If Republicans win everything, probably a little bit of deregulation. So that tends to be good for markets. But if you saw on the other side a Democrat sweep, and this is not a political statement on our end, this is just the reality of what would likely happen, is you'd likely see higher taxes. You'd likely see higher regulation. You'd likely see some anti-business sentiment going on. And so if the markets really thought that we were going to have a Democrat sweep, I believe we'd actually be already down today pricing that news in now. The market's always a forward-looking indicator of what's to come. So it's going to price this stuff in now, not after the election. So the odds of you being able to time this out, being able to know when to get in and get out and shift from common assets back to equity units and trying to sell Exxon at the all-time high and buying it back in at a lower point, that's market timing. That's a failed strategy. And if you met anybody who's done that successfully over time, please let me know who they are, because they deserve a gold star. It's very hard to time the market consistently. And so again, I go back to the goals-based plan, and I say if you're more than 5 years away from retirement, you should be very heavy in equities. And equity units at Voya are probably one of your best bets. Why? Because it's the S&P 500. It's the best 500 companies in the United States. Now, not every single one of those companies is perfect. Of course, there's issues with some of the bottom companies, but as far as your options at Voya, which are somewhat limited, that's about your best bet. So we like equity units. Be careful with some of the other options. We won't get into every single one of them right now. But the other great option is if you're nearing retirement, and let's say you're 2 or 3 years out from that date where you're ultimately going to leave ExxonMobil, we recommend that you have some money in common assets. I don't want to give general advice on this quick video we're doing. So you should have an individual meeting with a fiduciary financial advisor, whether it's us or somebody else. But we do like to use common assets right before you retire to give you a buffer in the portfolio, which should cover you about 3, 4, maybe even 5 years of living expenses in case we go through a longer downturn. Everybody has a short-term memory when it comes to downturns, because we do have periods in time where equities become overvalued, and you're better off having a diversified mix, having some in common assets, some in equity units, but don't do that too soon before you retire if you're not in that 2 to 3 year zone, because otherwise you're going to leave some return on the table. If you're in that zone where you're going to be close to retirement, you are going to be walking out of the company and you're going to need some distributions from Voya, or you're going to roll over Voya to an IRA, and then you're going to take some distributions. You should have a buffer just in case, like I said, we go through an extended downturn and there's a period where stocks are not up. So in the long run, I think the equity market will do just fine. I think S&P 500 in particular will do very well. That's your equity units option. And right now we're going to look at earnings in 2026, where the market will trade at the end of next year, north of $300 on the S&P 500. And so if you use basic valuations and you multiply earnings of about 315 times, anywhere from 20 to 21 times earnings on that number, just a basic math equation, I think you're looking at the S&P 500 north of 6,300 points within the next 12 to 18 months, giving you a 10 to 11% return depending on the day you're watching this video. So stay bullish, stay long-term focused, and most importantly, be on a goals-based plan, not risk-based, constantly worried about the short little ups and downs of the market, but rather look at your long-term objectives and make sure your advisor is giving you advice according to that long-term plan. It should be customized, not cookie cutter. You in a portfolio alongside thousands or hundreds of thousands or even millions of people, you should have a customized portfolio according to your goals. If you're not doing that already, you can give our firm a call, Stenger Family Office, 630-912-8295. It's 630-912-8295, or visit us online, www.stengerfamilyoffice.com, stengerfamilyoffice.com. We have a whole web page dedicated to ExxonMobil. We do have an ExxonMobil guidebook available for download that goes through a lot of these topics in depth. We hope to hear from you soon. Come visit us across the street from campus as well if you're around. We're in the same building as Common Bond on the fourth floor of that building. We'll talk to you soon. Take care.